Hey guys, and welcome back to the channel. Today we're going to be breaking down Pets at Home's full year 2026 prelim results. It did come out on the 27th of May. This isn't financial advice before we start. It's educational, and trust me, by the end of this video, you'll probably understand the business better than 99% of us, or at least hopefully understand a little bit more. Now, of course, I am trying to learn at the same time as doing these videos, so I am learning on the go. So I'm not always the best, but you know what? This is what I would do when looking at results, especially at a company that I own, because I do own Pets at Home in my portfolio. So let's jump into it. So as you can see, it's the UK's dominant pet ecosystem. It's not just a retailer, it's a three-pillar business. Now, at the moment, year to date, it's actually just down below 7%. A year ago, it's actually down by 25%, and 5 years ago, it's actually down by 57%. And 10 years, it's actually 23%. So, Pets at Home do three types of businesses or stuff that they sell. And that is one is retail, so it's like food, accessories, toys, essentials. They have the vet group, which is the real engine of profitability. And then they have like the central part of it, which is the backbone that ties it all together. Now, at the time of recording, it is actually at 192.2 GBX. Now, as you can see, the market cap is actually at 871 million. Now, it IPO'd in 2014 with a dividend yield at 3.75%. Now, this business has been around since 2014 as a public company, and it's been built a moat around the most emotional, sticky industries on earth. But the pet market is a market leader, and that is what Pets Home are also doing. So they've gone into the industry, and their investment case begins right here, because the UK pet care market is a 10 billion industry. Now, it's growing at roughly about 5% a year, and here's the kicker. 91% of the UK households own a pet. Or at least they say that owning a pet improves their life. Now, 94% of dog owners also say that dogs should be treated as members of families. So it's a high percentage of people that would treat their dogs, their pets, way above the expectations. So they would get treated, they get spoiled. And that would help Pets at Home. Because it's not just like a luxury, it's emotional spending. You know, people cut holidays before they cut pet food. And you know what? Pets Home have done very well. They sit at hashtag number 1 at UK's pet retailer at 1.3 billion sales. They're at hashtag number 2 UK's vet first opinion at 0.7 billion sales. And they're also at the 20% pet care market share. Now, of course, they're also the UK's only complete pet care provider with 460 pet care centres, 455 vet practices with 407 joint ventures, and they actually have 7.4 million active pet club members, which is the UK's most trusted pet brand and vet brand indeed. Also, we're talking about vets, and that side is actually the reason why Pets at Home are actually growing their revenue, because the vet side's booming for them. Now, the vet group has absolutely smashed out of the park. They've, in the consistent vet consumer revenue, they've actually got up 13% CAGR. Now, increased fees and income and PBT is actually up by 18%. And free cash flow is actually up by 28%. Now, this is quite elite for Pets at Home. This is part of the business that investors often overlook. But it's the engine that's keeping Pets at Home resilient and slowly building back up again. But why is that the case? Well, because vet services are high margin, high loyalty, high frequency. Once your pet is registered with your vet, you rarely switch. So, for example, when people go to Pets at Home, they sign up their pets, it's very much unlikely that they're going to go to a different vet. But if you haven't known what Pets at Home recently or haven't seen the stock, they've actually been doing a turnaround phase. They've actually been trying to turn their business around. And you know, not everything has been perfect. The retail side has still been underperforming. And Pets at Home knows this, and they've known it for a while. Because the turnaround play still focuses on the 4 pillars. Products, so like better ranges, better quality. Price, so sharpening competition and competitiveness. Education, so fixing store operations. And cost, tightening overheads. Now, this is a classic retail reset, but the question is it working? And this is where the story kind of shifts. The full year 2026 priorities show real movement. Now, of course, Q4 food volume was growth at 3.7%. Now, they also delivered 93 million PBT with H2 sales growth. Retail satisfaction increased by 4 points, 20% reduction in store gaps, and 20 million group overhead saving complete, plus ongoing productivity drive. Now, that is really good because these aren't small tweaks, these are operational wins that compound over time. And hard work pays off. And this sums it up perfectly. The early indication shows that retail turnaround is actually gaining traction, and this is what we as investors want to see. It's not hype, but measurable progress. And as you can see, value for money has gone up by 7 points, product availability gone up by 6 points, and promotional clarity has gone up by 5 points. So that basically means that customer sentiment is actually moving in the right direction. Like with all these, like value for money, product availability, promotion, clarity are going up. These improvements suggest that shoppers are noticing the changes, reinforcing the early signs of a sustainable recovery. And the next big thing is on its way, and that is pet insurance. Now, Pets at Home is launching its pet insurance in this year. Now, what does that matter? Well, it's a 2 billion market opportunity. It fits perfectly with retail and vets. They already have the customer data, trust, and brand. The FCA approval is already complete. Now, this is a vertical integration at its finest. Imagine owning the retail spend, the vet spend, and the insurance spend, all from the same customer. You're controlling all that in one avenue. You've got a tunnel, you've got a funnel, basically, as it's just each step is owned by the company. And let's get into the financial performance. And group performance is still strong, but there's still signs of improvement. Now, retail underperformance has dragged this group, but underlying the financials remain strong. Now, group revenue was 1.98 billion, which is a year-over-year, or 1% year-over-year. Now, the group underlying PBT was at 92.8, which is down by 30% year-over-year. The group free cash flow is actually down by 26 year-over-year. Now, the vet group is actually up by 5% year-over-year. Retail is actually down by 1%. And vet group and retail are all doing very much good indeed. Now, the leverage is also 0.1x, which basically means, from my opinion, I may be wrong, so comment down below in the description. That means that it's pretty much low debt, or basically debt free. I might be wrong, so do comment down below in the description. But those are pretty much the financials. They are showing that there is signs to keep working on, especially the group underlying PBT and the group free cash flow. That is something that would be something good. But for the group consumer revenue, getting up by 1% year over year, it's a slow tick. It's not brilliant. It's not flashy, but it is good to see. Now, of course, the revenue breakdown and vet group continues to grow because it grew over 6%. Now, again, proving that it's the best thing for pets at home. But retail, flat food sales, but you know what? Own brand food grew by 3%. Accessories drug performance, classic discretionary slowdown, but the key takeaway is the core essentials remain stable. Now, that is a good thing, especially because you do need the prices to hopefully start building back up. And especially with the vet group, you can't rely on that for the long term. You need the retail to also be in a profit. So what drove the PBT down? Well, this slide is normally gold for investors. So where did the money go? Well, most of it went into the vet trading, retail GP's investment, which is down by nearly -20, product initiatives, external headwinds, bonuses, and insurance surplus cap codes. Now, this is a transparent breakdown. It shows the turnaround is costing money up front, but productivity gains are already offsetting some of that pain. And as we mentioned, the free cash flow is lower due to retail profitability. Now, it is for a good reason, slightly. because retail profitability dipped, but the vet group remains a cash machine. Now, if the turnaround play does turn around and actually succeeds, this is a temporary thing. It's not a structural issue. And the capex is normalizing. Investment is back to normal levels for peak years. They've got it down to now 42.1. Now, that's good because that is 42.1 million, because that is what they were nearly at in full year 2024, full year 2025, but also they're not that far off from being where it was in full year 2021. This is still investing in digital transformation and its infrastructure, but sustainability. This is exactly what you want to see from a maturing business that is doing its turnaround play. And for the dividend lovers, as you can see, Pets at Home returned over nearly £490 million. Now, over the last 5 years, they've actually done that by 430 million with share buybacks and dividends. Now, full year 2026 alone, they've done 59 million in the dividend and they're doing 25 million in buybacks. Now, in full year 2027, they're actually doing a 50 million share buyback, which is good because they're also bringing their ordinary dividend rebase back to 50% payout, plus an upweighted share buy program. So for me, this is a shareholder-friendly company that is doing very well in its turnaround play. And here is the guidance that they released. So as we mentioned, the 50 million share buyback with a dividend of 50% payout ratio. Now they're doing their 50 million capital investment, 26% effective tax rate, and the group underlying PBT is conscious. So what is the big picture? Well, Pets at Home is a business in transition. It's a booming vet division, a retail turnaround gaining momentum, a new insurance business launching, strong cash returns, a rock solid balance sheet. But this is a long-term compounder in the making, if the management executes it, that is. Now, we just need to make sure that for the next earnings or that the turnaround play is showing its progress. But that is pretty much it for today. Comment down below if I missed anything or anything that I need to improve on. But if you did learn something today, hit the subscribe button, make sure you leave a like, and if you want to see any more stock analysis like these, then of course, I'll see you on the next one. Goodbye.